Hello and welcome to the Private Capital Podcast. I'm Joe Riley at Circulus Group, a network for family offices based in Greenwich, Connecticut. Next Family Office Summit is on November 20th in New York. It will feature Mitch Julis, co-founder of the legendary Canyon Partners, Divya Narendra, founder of Sum Zero, Jose Minaya, head of investments at BNY, and former podcast guest Ken Cancel, president and CEO of Churchill Asset Management. Please subscribe to circulus.substack.com to stay in the loop. Today's guest is Avi Kalichstein, the CEO of Hunter Point Capital. He's deeply invested in the rapidly expanding world of private equity stakes. We delve today into the influence of his father, a renowned pianist, and his early career at Goldman Sachs, where he met Chris Flowers, who significantly impacted his career. Flowers sent him to Japan to work on revitalizing Shinsei Bank, which was an education in cultural nuances. We also discussed his meeting with Bennett Goodman and the decision to establish Hunter Point. This conversation covers the evolution of private equity stakes, their unique approach to viewing firms as businesses rather than just funds, the size of the market, the barriers to entry, valuation models, and how transactions are made with long-term commitments in mind. It's an in-depth exploration of the GP stakes landscape. Avi Kalichstein co-founded Hunter Point Capital and serves as its chief executive officer. Before founding Hunter Point, he was a managing principal at Easterly, a firm investing in and building investment management businesses. Previously, Avi was a managing director at J.C. Flowers and began his career in the financial institutions group at Goldman Sachs. Avi earned his BA in Mathematics and Economics, magna cum laude, from Brown University. Please enjoy my interview with Avi Kalichstein.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Maybe we could start with your father, who had this incredible journey as an immigrant to a concert pianist. Could you tell us a bit about him?
Of course. My father was born in Israel, and at the age of 2, I'm told, he wandered into a neighbor's apartment and started fooling around on the piano. And somebody said that's not a typical 2-year-old's banging on the piano. So he started studying piano, and at the age of 16 was admitted to Juilliard. So he moved to New York with his mother, didn't speak a word of English, moved to the Bronx, and basically found his way through school, through undergraduate and then graduate piano at Juilliard, was trying to work along the way to make ends meet. He came from no means whatsoever, and his first job was at a haberdashery where he was trying to sell hats and belts to New Yorkers. He was fired, I think, within about 2 weeks. And realized that he was going to have to make it in music. He was very fortunate and worked extremely hard. He won a very significant piano competition called the Leventritt in 1969, and that launched a solo career. He ended up playing with George Zell and the Cleveland Orchestra, played all around the world, and spent the next 60 years or so in chamber music and solo music and orchestral music. So he had an extraordinary life in music and in the arts. So,
Did you ever consider?
I play the piano, I play the guitar, I write some music. So it has always been a part of my life and will always be a part of my life. I made the decision early that I was never going to be anywhere near as capable as my father. And so I just couldn't live in his shadow. He had a calling in a way that people do for the thing that they're meant to be. And I didn't have that same calling for music. So the ability to sit there for 8 hours and to practice slowly and methodically. Interestingly, as I've become older, I have more patience for that and I have more discipline for it. But as a 12-year-old, I didn't.
How did you find your way to finance?
I loved math. And math and music, I feel, are two sides of the same coin in a way. They're both extremely artistic. And I loved studying problems. And math's a sort of series of pattern recognition and puzzle solving. And I loved that. I went to Brown. I studied math and economics there, and we'd had a family friend actually through a music connection who had been in investment banking. And when I was a little boy, I'd said to my mom, what does that guy do? And she said, he's an investment banker. So I was 6 years old or something, said I want to be an investment banker too. I followed that path. I started out at Goldman right out of college, and I wanted to be in the tech group. That's what I thought would be incredibly appealing and sexy and fun-filled and avant-garde and everything. And the recruiting people at Goldman would take your preferences and write them down and spit out some algorithm, and that they'd place you in a group. I don't know how scientific it was, but they put me in the FIG department, the financial institutions group. And I thought there was nothing more boring than being in the financial institutions group. It's going to be banks and insurance companies, and these businesses didn't even produce anything. And so I was bereft. And then I started doing some research into what it was and what they were doing. And I found a Wall Street Journal article with Chris Flowers' picture. And I was placed in this big group at Goldman, and I was assured that I would be among the busiest groups at the firm in that period. And lo and behold, it was in the mid 90s, which was in the middle of the bank merger craze, that the period in which regional banks were merging to create the national banks that we have now, the JP Morgans, Wells Fargo, Bank of America, and Cities. We didn't have that until that time. All the banks were regional and super regional. I was promised a very busy time, and they delivered. I did $100 billion or so of merger work, and I happened to have been placed right outside Chris Flowers' office. We shared an assistant, and I would eavesdrop on his calendar and try to understand what he was doing. And this maybe makes me laugh when I think about it. I was a recent college graduate. I think I started my program at Goldman. I was still 21 years old, and I thought Chris was an old guy. For one thing, he had a picture in the Wall Street Journal, and that obviously meant that he was advanced in his career. And I met him at the introductory cocktail party, shook his hand, and I felt very important to have shaken his hand. And, but I thought he was an older guy, and it turns out he was 38. So much for perspective.
I think it's interesting, considering your current career, that you were at Goldman during the great IPO debate. At the time, Goldman was capital constrained and they were losing talent to hedge funds. Do you think that your experience then influenced the way you look at the industry now?
I do. I think in the mid 90s was the beginning of when we started to see the convergence of alternative investment management and insurance. And sitting in a FIG group, those of us at the investment banks were looking at insurance companies and starting to see the ways that they could work with alternative investment managers. That didn't come to fruition for another 2 decades or so, but there were early signs that was going to be interesting.
So what was life like back then? It must have been frenetic.
Yeah, that group, led by Chris, but not just Chris, was in the middle of every single important conversation with a big bank or insurance company or an asset manager. There was a tremendous amount of M&A going on at the time. Some of the mutual insurance companies were considering demutualizing or creating what was called mutual holding companies. The banks were merging, the investment managers were acquisitive. So it was just an unbelievable boom time for FIG. And Goldman was at the top of the league table. So I was very fortunate to be sitting in that seat. And like I said, it wasn't the one that I chose, but it was chosen for me.
And then tell me about the shift to Shinsei. Tell me about the Shinsei deal. That was an interesting deal at the time. I think it was the first time private equity had actually gotten involved with a bank in Japan.
Yes, it was. And I moved to Japan in 2001. So shortly after the deal was consummated. And the complexity of that business, because it was one of 3 long-term credit banks in Japan, meant that the only way to make a deal with the Japanese government that had taken it over in a reasonable time frame would be to arrange some sort of risk-sharing mechanism, which the purchase group did. And so one of the things that became difficult operationally at that bank was to manage this risk-sharing agreement. And it basically meant that if loans degraded by a certain amount, then you could sell the loans back at par to the Japanese government. And I imagine that the government didn't expect there to be as much degradation in the loan quality as there was. So it turned out to be a very large financial asset for the buyer group, which basically guaranteed the credit quality of Shinsei. But documenting it and working with all those borrowers and figuring out a plan was really complex. So it was fascinating to do. And then ultimately was successful. Shinsei, following the leadership of Yashiro-san, who was the CEO at the time, created a retail offering, which was, I believe, the first of its kind for a long-term credit bank, which were not generally organized around a retail offering. And then ultimately the bank went public. It was a huge success story, a tremendous amount of work. I learned a lot about a different culture, about communicating clearly and succinctly, people who didn't speak English very well. The Japanese culture stressed seniority and measured by age and not necessarily measured by anything meritocratic the way we might do in a Wall Street setting. So that was really different. And I was 26 years old or something like that when I started. And it was a real shock for me. And I came out the other end of it much more patient, much more understanding, much more willing to work with people. So it was a real lesson for me and an invaluable time in my career.
Any other lessons?
I learned so much. One of the biggest lessons was really about the difference between industrialization and westernization. And so Japan is quite industrialized, but not westernized. So
What does that mean?
some of the key cultural symbols that you might, just to give an example, a key cultural symbol that you might think is universal, like you put up your hand to indicate that there's a stop. That's not necessarily a universal symbol. And so one of the things I learned is that the things that I thought were innate turns out to have kind of cultural attachments to them. One of the important lessons for me from Japan was patience. So things happen over a longer time frame. The building of consensus is an important societal value in Japan. And so things tend to take longer. So one of the reasons I think Westerners fail in Japan is because particularly New Yorkers who come in with an attitude that I can change everything in 15 minutes and we're going to do it my way. There's a very strong dynamic there that keeps things moving at a much more deliberate pace. So I learned how to be patient when I lived in Japan. The interesting thing is now that I'm spending time in Japan, it reminds me of that old joke, a startup being a 10-year overnight success. And Japan in some ways is like a 30-year overnight success. So now we're spending time there at Hunter Point and we're seeing incredibly sophisticated developments, particularly from the Japanese institutional LP community. They are turned on to private credit and really thinking intelligently about how to develop that for their own needs. And so this is an evolution that people saw coming and nothing happened. And now we see real green shoots among the institutional investment community there.
And then you came back to the U.S. and we'll just skip ahead maybe to the financial crisis because it seemed Flowers and his firm were involved in every major transaction, or at least were in the room.
I would say the financial crisis was so overwhelming and so monumental that we ended up playing a tiny little bit part in a very complex play with obviously the federal government, the Treasury, the Fed. But Chris was really at the heart of all of these conversations, and it put the firm in just an incredible position because he was such a trusted advisor to the titans of the banking industry. So we ended up having a team out the big weekend in September 2008. I was camped out at AIG trying to sort through that. This was before the government took it over, which I believe happened Tuesday morning. But I was camped out. We were trying to make a bid for AIG, and a different team was working with Bank of America to work on the Merrill Lynch deal and then that merger. And so it was just the kind of plate tectonics that were in motion at a rapid speed were just overwhelming. And so that was one of the most intense weekends of my life. So you ask, how do you do that? I felt, for me at least, it was reactive because the government came in and they made sweeping declarations. And this was before the TARP program was put in place. So people were trying to figure it out. I remember Chris being on the phone with senior government officials, because I don't think they had a plan at the time to know how everything was going to unfold. And then obviously things got much more organized after AIG and Lehman fell and the Bank of America Merrill Lynch merger.
One of the really interesting things about GP stakes is you folks approach funds as businesses. You turn the tables on managers, so to speak, who themselves are specialists in analyzing companies, and you put them under the microscope. But maybe before we talk about that, you could talk about when these firms actually became good businesses, aside from just raising funds.
About 10 years ago, perhaps, GPs started to look in the mirror and realize that they were running businesses themselves. They weren't just a collection of investment professionals doing deals. And those, maybe a little bit longer than 10 years, maybe 15 or so years. The largest of those figured that out and went public. But the next generation of those firms were still not thinking that they were themselves businesses. And so analyzing themselves, having budgets, having plans, thinking about diversification, thinking about their customer bases, all of that on the GP side. And then there were lots of evolutions on the LP side too that were causing those interactions to change. But I think GPs began to think of themselves as platforms. They started to focus on talent development, for example, making room in their businesses. One of the great reasons for GPs to grow is to provide enough runway for the next generation of leadership to develop. And I would say at the advent of private equity, nobody was thinking about that. It was not until some of that first generation started to think about life after work that they began to think, oh, we better make enough room so that our stars can have a place to work, because if we lose them, then everything will collapse. So there were a number of those kinds of catalysts. And as a result of that, the natural evolution in that thinking was starting to think about capital structure. So the business over time, as firms became successful and grew, became capital intensive in a way that it just wasn't in the beginning. So the more successful you were, the more capital you needed to either launch a new business or seed a new strategy, or even just invest alongside your LPs in your next ever-increasing fund. And that started this movement that has led to the GP stakes world, where the growing, thriving firms are thinking about their own balance sheets and what do they need in order to be successful, to be competitive, and to grow.
Do you think managers today have to have a different skill set from managers, say, back in the 90s?
I do. I think the world is much more competitive than it was then for capital. There are certain channels of capital that are becoming more saturated. So the need to develop skills and techniques that are more specialized and more special, frankly, than they necessarily were before. We also, starting 4 years ago, had a change in the interest rate paradigm. So for 15 years or so post the financial crisis, private equity was on a tear, particularly. So borrowing cheaply, investing in businesses, they would grow. We didn't really have any recessionary pressures, and multiples would expand, and cheap money fueled that growth. And so there was a boom in the private equity business that was fueled, and to some degree, by cheap money. When the cost of financing became more expensive, business models that were reliant on inexpensive financing all of a sudden were exposed. And those GPs that are fundamentally focused on revenue growth and expansion of businesses and were less reliant on what we typically call financial engineering, those businesses continue to thrive. And so there's been a separation of kind of the wheat from the chaff, the special firms from the more copycat type firms. And so we've seen that play out, and that's really a skill set and an orientation matter. So some of that's been evolved over 2 decades, but we're really seeing the exposure now.
So a lot of fund managers often break out as stars, but as the vintages stack up, they begin to think about proper institutionalization. What advice do you give those firms?
When we work with managers and we look for managers, particularly in private equity, we're looking for, as I said, special groups, but institutionalized and process-oriented managers. So the more repeatable their processes can be. That could be on origination, it could be on recruiting, it could be their post-acquisition plans, it could be how they formulate those plans, how early they formulate those plans, how they work with management teams, how they bring in either operating partners or other board members to assist. All those things, the more institutionalized it can be and the more repeatable it can be, the better the business is. And I say that because as businesses scale, their reliance on one or two people, it just can't work. So you want to be able to hire, to train, and then to be able to repeat those processes over and over again. That's also let the best managers expand their platforms into other products because they have a system that they know works.
How big is this market?
I think there are probably something like 1,500 GPs in the stakes universe of a certain size. There may be as many as 3,000 or more if you go down to smaller GPs. So there are half dozen to a dozen firms that are looking to do GP stakes deals, and they do somewhere between 2 and 6 or 2 and 8 of those deals a year. So there's a pretty big addressable market. It's very difficult to start a GP stakes firm. I think the table stakes today require one to have a definitive edge and some specific tools to be able to help GPs grow. It's how we created our business. It was mainly about how we could help GPs on their trajectory for growth and their creation of enterprise value and sustainable franchises. That was the orientation, as much business building as it was investing. And I think there's a big market for that. The other thing that's developed for Hunter Point Capital is we started as a GP stakes firm, but we are now a GP solutions firm. And the market for offering a broader array of financial solutions that are purpose-built for the needs that a GP might have, that is actually quite broad.
Back when we were looking at GP stakes 20 years ago, it was a complicated transaction. They were always hamstrung by all the friction, documents, agreements, all the moving parts. As the field matured, is there a real market out there for stakes, or is it still all relationships and one meeting at a time kind of thing?
A GP stake, in our view, is a perpetual partnership. And so the importance, like in marriage, the importance of finding the right partner can't be overstated. So in a perfect world, one would spend lots and lots of time with a prospective partner to understand how that partnership is going to work. What is the value added that the GP can really expect from the stakes partner, and make sure those expectations are calibrated appropriately. And the longer that a group like Hunter Point Capital has to spend with a GP, the better we can ascertain what their trajectory is like, what the manager's kind of feelings are about the future, and what they're interested in. So I don't think any of that can be rushed and still be successful. There have been a fair amount of standardization of how certain things work in every GP stakes deal. So that's been helpful to try to reach a kind of common ground of how the kinds of terms that go into a GP stakes deal. But in our experience, and we've made 10 investments in our GP stakes strategy so far, everyone's a little bit different. What those firms need from us, whether it's capital formation, access to our procurement group, some general business building advice, executive talent and coaching and development, that each of those things is bespoke in what those firms are looking for. So we haven't yet found a way to crank these out in a cookie cutter fashion. And I don't think it's really meant for that.
What alternatives are there for GPs who need capital but don't necessarily want to sell stakes? Who else is offering solutions to these firms?
Let's start with Hunter Point Capital. So we're offering today alternatives to stakes, and that could be something like a preferred investment, which is a secured investment in a pool of collateral. Mm-hmm. That's very flexible, all the way to a loan, which is going to look like a traditional bank loan. It would have a 5-year tenor, and it's got to pay cash interest, and it would have real default kind of characteristics. So there's a spectrum ranging from a loan to a permanent equity stake. And this is what I meant by looking at their capital structures. GPs are thinking about their balance sheets and saying, just like for a corporate, there's room for an equity there's room for equity, there's room for debt, and there may be room for a preferred in the middle. So not every GP wants more than one of these, but there are now quite a number of solutions to these kinds of capital needs. And I think there will be more proliferation of that. And the largest GPs might be able to issue debt in rated debt, investment grade debt. The smaller ones won't be able to do that. And so we're here for the middle market to try to fill all their gaps.
I assume they have relationships with their prime brokers or the big banks. Why wouldn't they just go to Goldman or Morgan Stanley?
I think the big banks traditionally are focused on their largest clients and satisfying those needs where the relationships are multifaceted. There may be 6 or 7 or 8 different product groups that are servicing those GPs. So a loan to the GP might be one leg of a many-legged stool, right? An 8 or a 10-legged stool. For GPs that are, let's say, middle market GPs that don't have the breadth of those relationships or the breadth of those product uses, they're less likely to find a home at a big bank for a loan. In addition, the risk departments at those big banks are more interested in certain kinds of financing products, and they're not interested in others. So finding the creativity and the bespoke solution is something generally that the banks aren't offering, which is one of the reasons why there's a need for groups like Hunter Point Capital.
So I want to ask you a couple of questions about process. One would be how you filter and find the funds, but I'm also curious, I often visit funds, and I'm always curious what the internal process is like. What does a week look like? How do you actually look at the world? How do you actually decide, how do you divvy up the work and decide how to attack this market?
We've become very focused on our GP relationships. So we have, I think in the past 18 months or so, touched or spoken with about 300 GPs. We have about 600 global GP relationships. That's not just in private equity, that's across the spectrum. Private equity, private credit, real estate, and infrastructure. And this may sound irrelevant, but we have almost 3,000 LP relationships. And we're constantly talking to those LPs about what they're doing, what their predilections are. And so one of the fascinating things is to talk to those GPs about what we're hearing from the LPs, and then vice versa. So we serve as this kind of nexus of information flow. So it's hard to say what a typical week looks like. I would say our whole orientation is towards solving problems and trying to reinforce opportunities for GPs. So we don't generally talk about a product or a term sheet or a deal. We're generally talking to those GPs about what's going on in their business and where they're headed and what kinds of either opportunities they have or problems they're facing. And then maybe there's an opportunity for us to solve that with capital. We are proactively meeting with GPs all the time, and some of that is thematic. For example, we were quite interested in having a real estate GP in our portfolio of GP stakes, and we ended up making an investment in a fantastic GP called Pretium. But we sought out real estate as a theme because we were looking for that kind of diversification. So it's a benefit of our business model that we have these strategic dialogues because that leads us to finding the right GP to fit in the mix.
Is this more of, as you've been telling us, more of a relationship business?
It's really, I think the approach is much more like a sandwich. You come at it from both sides. So there is this thematic origination concept of what are the kinds of firms that we'd like to see among the portfolio. Then there's who are the best firms in those fields. And then we go about figuring out whether do we know them already, do we not know them, and how do we find them. At the same time, there's an organic process around getting to know what really the culture of these firms. They have to have a desire to grow, and they have to have a culture that's around fostering the next generation, creating franchise material. So firms, I'll just give you an example, firms that are terrific investors, but they really can't grow beyond what they're doing. So every fund they do is 4 times multiple of money, and it's $1 billion fund every time, and they're going to do that until everyone drops dead. That's a great investment, to make as an LP, it's not a good GP stake. And so that's not a franchise because ultimately the people retire and it's over. So the chemistry part of this, or the alchemy maybe even, is about finding those firms that are terrific top quartile or top decile investors that have created those repeatable patterns of investing so that if one person retires, they can keep doing what they were doing without a hiccup, but that also have the LP relationships and the demand to continue to grow.
How hard is it to arrive at a valuation?
The dirty secret of this is that the valuation part's pretty easy. Most of these GPs, private equity guys, credit guys, real estate infrastructure, they are very sophisticated financially. They do not need a lot of education around what their businesses are worth these days. There have been enough GP stakes transactions. It's a small enough community that very frequently, and in our case, most of the time, GPs are coming to us and saying, the services that you can provide us, the benefit that we can get from working with 100 Point Capital is maybe more important than the capital itself. And in several of these instances, they've just come to us and said, we'd like to do this with you. Here's the price. And there's maybe a little bit of negotiation around that, but it's in a pretty tight band, actually. There are some more complicated elements of getting these transactions done that are more about terms and conditions and minority protections, and they do tend to take a long time to gestate, but the valuation part's generally pretty quick.
I guess I would ask you what comes into that equation. How do you model the carried interest going out? How durable is that income stream?
Carried interest is a very broad term, and so in private equity funds, just to give you a sense, there are firms that have a European-style carry waterfall, meaning that they have to pay back all of the principal of the entire fund before any carry is generated. And then there are firms that have an American-style carry waterfall, where they earn carry on every deal as it comes to fruition. Those two things are quite different. If you have a European-style fund that's in carry, it means that all the principal has been repaid already, and there's much less likelihood that there's something goes wrong. An American-style carry waterfall, in the very beginning, you could generate some carry, but it could be clawed back if the later investments don't do well. So those two things are fundamentally different to analyze. And then you have real estate funds, which generate less carry, credit funds, generally even less carry than that, but in a much tighter band. We call those incentive fees, and they're much more predictable because the outcomes of those investments are much more bounded. There is a science to understanding the dynamics of this, to discounting those both based on risk and also time. And one of the things we've seen fascinatingly over the past several years is in the market in general, because of the molasses that has stuck the M&A market, there have been fewer dispositions of companies, so fewer realizations and less recognition of carry in the private equity world. It's not because it's not there, but it's been deferred. And so sophisticated GP stakes buyers have to plan for those kinds of deferrals because the trees don't go to the sky.
Has anything surprised you? You've worked with some very prominent firms. Has anything surprised you in doing diligence on these firms?
We haven't had a surprise in diligence, so that we've not had one of those. I would say from a deal doing standpoint, it has surprised us how long these take to get done. And part of that is these are successful firms, all of them. So we've positively selected into a universe of very successful firms, and there's a high demand on the principal's time. So they may be in the middle of fundraising, they may be working on a bunch of new deals, they may be trying to do a continuation vehicle, whatever it is, they're busy. And so while the GP stake is important, it's very frequently can get preempted by their clients or other things, their annual general meeting. So that ends up taking a little bit longer than I would have predicted. The other thing that surprised us is the variety of different kinds of uses of our strategic services that different managers want. So they don't all want the same thing at the same time. There are certain managers that want to take advantage of our capital formation group and their strategic thinking about the landscape of LPs, about broadening and widening the LP networks. There are other groups that are more focused on savings they can generate through our procurement network. There are other groups that are thinking about existential issues. Should we buy a manager? Should we open an office in Europe? And that kind of business building experience that our team has had can lend itself out. But there have been inconsistent patterns of when those have been applicable. So I'm constantly surprised at the lack of consistency.
So how did you meet Bennett? How did you guys decide that this is what you wanted to do?
Bennett and I had gotten to know each other when he was at Blackstone, and we're just comparing notes about the GP stakes business. He was not directly involved in it there, but had a ringside seat. And I had been developing this model of trying to bring strategic value to GPs. And that was not something that we saw any of the other GP stakes firms doing in an independent way. Most of the other GP stakes firms are part of bigger financial institutions. So Bennett left Blackstone. He'd been there for 15 years or so. And we decided to team up to build this together. And given his relationships and background and my background in financial institutions and in private equity, we thought we'd be a good team to build this together. And that's turned out to be true. He's an extraordinary friend and mentor and partner, and I'm really lucky to be in business with him.
Your first deal with Ted Virtue at MidOcean Partners was pivotal. What can you tell us about that?
That was a storied firm that had been around for over 20 years. That had been excellent investors. MidOcean had both a private equity business and a credit business. And we just saw a tremendous amount of opportunity for growth there in both of those domains. So MidOcean is a firm that, again, had 20 years of history and track record. And so for us, we felt very fortunate to be able to find a firm with that kind of background and history as our first investment.
And so how did it come about? How did you structure it?
Bennett had known Ted Virtue for 30 odd years. I had known Ted actually in a different capacity for a while. We'd both had connections with various members of their credit team. So it started with a very strong level of trust, which is very frequently helpful, but also a testimony to the networks that we've brought to bear in the GP stakes business that we built. So our fundamental structuring thought, and all these transactions are slightly different one way or the other, but our fundamental philosophy is a GP stake is an extraordinary way to be aligned with a manager, to be the most aligned you can be with how those people are generating wealth for their families. And so we like that equity business in that it's aligned. So if we could be a partner in everything they do, if they make a right turn, then it's good for us to make a right turn. If they make a left turn, it's good for us to make a left turn. And that's really the philosophy that's driving all of these transactions.
And how is that different from, say, a very large, very successful fund like L. Catterton?
We bring the same philosophy to bear at a firm like L. Catterton, which is a larger place, as you point out. But I think the underlying thesis of here's some smart guys, they've got a really good business. We think we can participate in a way to make it better, either to help them achieve their goals faster or with more certainty. And we want to be attached at the hip so that we'll follow their fortunes. The GP stakes business is a non-control business. So I would say, want to have influence by virtue of the relationship and the services we can provide, but we don't control any of these businesses. So that alignment is even more critical.
Do you have any thoughts on succession? How should these firms plan for the inevitable and retain alignment with partners, with your fund, and with the next generation of talent?
Succession is different at every kind of firm. I think one way to think about that is to create a partnership group that has resilience so that it's not relying on one person. So that can be done long before somebody needs to retire. And there are various firms that have done that. You can count the number of managing partners on the website, and that'll give you a sense of how they're thinking about the control of the organization and how they're thinking about what potentially could be a future. I think the advice that I would give to any GP is don't let succession sneak up on you. When you're too young to retire, put a plan in place such that when you're ready to retire, that plan has already been through its phases. And some of those phases could be vetting of the next generation. So you don't need to anoint a 25-year-old to run your firm much, much later. But you don't want to come into the office on a Monday and say, oh, you know what, today's my last day, without having made the appropriate plans for that. And that includes socializing the next generation with LPs. It includes making sure that the investment committees are structured the right way, that governance and compensation is structured the right way. So there are a number of steps that need to be put in place.
A lot of these firms are run by folks who are, like I said before, they're stars. They're folks who have built a reputation in the industry. They're used to calling the shots, and they think they're going to live forever.
Right.
So what advice do you give them? What structures do you try to put in place to smooth that transition?
We look at those sort of different categories, whether that's going to be LP relationships, who leads those LP relationships. So let's just pick that category for a moment. A succession plan won't work if the managing partners are the only people who have the LP relationships. So probably 10 years before a managing partner is going to retire, there needs to start being other people who build those relationships. It could be in parallel, but there are other members of the firm who are out in front of LPs, such that on the date of a retirement, let's say, there are no surprises for the LPs. The LPs see it coming, they've endorsed the change, they understand how it's going to work, what is the pro forma role of that founder, CEO, chairman, whatever it is. And the earlier that's done, the smoother it is. And so I'd say there's a similar kind of plan that needs to be put in place in each of the categories. That's investment origination, that's investment underwriting, that could be how the investment committee works, it could be hiring and firing. So all of those things need their own path and have slightly different timing, and they may not all yield a single successor. So it's not like one guy leaves and another woman succeeds him. It could be someone's going to retire and 5 people then take over that role.
Shifting gears a little bit, maybe we'll talk about the industry itself. We had talked, I think, previously about private equity's move into the wealth channel. So I'd be very interested in what your thoughts are on the industry in general and how that's shaping up.
There's no doubt that there's a tremendous amount of capital from high net worth individuals that is heading toward alternative investment management. So estimates I've seen range up to $6 trillion over the next 5 to 10 years. So a lot of money. There are some products that work better for that channel than others. So there's some particularly certain reasons why it's difficult for certain products to be successful, I think, in the wealth channel. Private equity is one that I think is particularly ill-suited for individual investing. And that's for 4 principal reasons. One is liquidity. So a doctor or a lawyer could wake up for one reason or another and say, I need my money out of this investment. And private equity is particularly illiquid. And so that is a mismatch there. There's a ramp associated with private equity. So it gets called over a span of 4 or 5 years. Generally, individuals want to make their investments and put their money to work immediately. So you have this chasm to bridge in that individuals want to make investments day one, and the private equity firms would like to draw that capital down over some number of years. Typically, private capital funds, drawdown funds, have a J curve, meaning they're collecting fees and not making investments, or they make investments at a pace where the initial results are negative for some short period. And then it flips over time. But the explanation of how that works for an individual investor is complicated and needs a lot of hand-holding so that people don't panic. And then finally, private equity doesn't generally result in a yield. And most of the successful individual products, alternative products, are yielding. They might be direct lending product or a real estate product. Private equity doesn't generally create a yield. And so I think for those reasons, it's a complicated and difficult product to fit directly into high net worth individuals' portfolios, or at least certainly the mass affluent. I think it's challenging. For very high net worth individuals, there's a good home for it. And certainly there are variants of private equity like secondaries that I think works really nicely.
Do you think the industry itself changes when this potential trillions of dollars comes into it?
I think it will change. And you already see that to some degree in the products that are being created that are for sale. They have different characteristics than the institutional products. So the perpetual products, whether they're tender offer funds, for example, just to use a tender offer fund, that's a very different kind of offering than what an institution would have bought 5 years ago. That's not to say institutions wouldn't be interested in that, but it's a real evolution in just the product dynamic. So I think you're seeing already a migration or a development or evolution of the industry toward something that's new because it's suitable for that channel, for the high net worth channel.
Where do the returns come from in this space? Is it just fee revenue, or is there an expectation of sale?
To align with managers who are on a growth trajectory, many GP stakes businesses are structured as permanent capital vehicles. Not all of them, but many of them. And as a result, they're income generative. So when they own a stake in a manager, they're getting a percentage of that manager's profits, whether that's from fee income or from some kind of incentive fees in a mixture. Over time, if the investments are good, then those yields will grow and the fees will grow. And so it generates a compounding yield. In the meantime, the manager is becoming more valuable. So in the background, you have growth. So it really is a growth strategy, but it doesn't have a natural exit. So GPs are not expecting their GP stakes partner, their marriage partner, if you will, to want to sell that stake or to force some kind of liquidity event. So the liquidity that's required has to come, I think, at the LP level, so that ultimate investors in GP stakes funds can find some liquidity beyond the annual yield that they might be generating.
How do you think about risk within your own portfolio?
There are several ways to think about that. We think about creating resiliency by having diversification across geographies, across product types. So not all private equity, some credit, some real estate, some infrastructure, and also across vintages. So the managers we're investing in are not all raising money at the same time in the same way. So that creates, we think, a great degree of diversification. And that's the resilience of that yield that I mentioned we're aiming for. That's, I think, the best way to mitigate risk. So you don't have a lot of pro-cyclical risk around one industry. Sometimes when private equity is having a hard time, private credit is having a boom time. So these are like planets orbiting the sun, that they're not all in the same orbit. And so trying to keep a group of them in different orbits is really the name of the game.
So I'm an LP. Where does Hunter Point fit in my allocation? Is this private equity?
We have and will continue to struggle with that. We are like private equity in that we're generating growth in the underlying managers in which we invest over time. And so if you had to choose between private credit and private equity, we're like equity in that way. But most equity investments don't generate a yield. So we do generate a yield, and we're doing that much more like credit products would. So I think GP stakes are really a hybrid of those two. And we found that in the marketplace, investors are split as to how they view the sort of bucketing of GP stakes.
Where do you think it should fit?
I think it is a hybrid. It really is a hybrid. And I think that certain investors that have the flexibility to think opportunistically don't worry about this. And those investors that have specific teams because they're larger organizations and they need to be bucketed because that's how they think of the world, they'll continue to struggle with that. But I really feel having multiple personality disorder about it. I could really go either way.
Should I take a GP stake if I'm offered it, or should I just put money in the fund?
Those are completely different investments. We believe that GP stakes are an incredibly aligned way to invest with a manager, but you'll get a similar exposure to a credit manager by buying a GP stake than you would to an equity manager by buying a GP stake in that manager, even though you'd get a completely different result investing in the funds of those managers. So I really think there's complementarity to these things, but they're really not in any way the same kind of investment.
How has working with all these amazing funds affected your plans for Hunter Point?
One of the benefits, one of the thrills of what we do here is the exposure to the brightest minds and the best managers across a broad spectrum around the world. So there's a macro component to understanding what's going on in the residential real estate market that we get from Pretium, to the global consumer that we get from L Catterton, to the healthcare market that we get from Vistria. So for one thing, it is a university level setting in terms of understanding what's going on in these different markets. And that's both thrilling, but as you say, it does lead us to make conclusions about where the world is going. And so as we think about where Hunter Point could go, it's a dynamic feedback loop of what are the challenges GPs are facing, what are the opportunities they have, and where might we be able to provide solutions where there is none. So when there's value to be added, that's where we think about the firm trying to go over the next 5 to 10 years.
So you mentioned before, you sit at this fascinating nexus of information. There's 600 GPs.
In our broader network.
Yeah, and 3,000 LPs. What is one surprising trend that you're seeing from these conversations right now about where the private markets are headed for the next maybe 2 years?
I don't know if it's surprising, but I would say it's controversial, perhaps, that there's, I think, a general feeling that fundraising is hard and there's this sort of doom and gloom around fundraising. And certainly there are pockets of fundraising that have been very difficult. Middle market, private equity fundraising has been difficult over the past 24 months and looks difficult this year too, in general. The special firms that I mentioned before, though, are soaring through their fundraisers and meeting targets. In this network of GPs that we know, we've seen firms that have had a single close and they've raised all the capital that they hope to raise. So there are, I would say, silver linings to all the dark clouds that is not talked about that much. Similarly, a lot of private credit managers have had banner years of fundraising, despite what you might read in the newspapers. So I think the surprise is the layering and the texture behind the broader market. So people will make sweeping statements about the state of private markets, and they're really talking about a specific subset within private equity. And it's quite different if you look at it at a much more granular level.
Do you think this market consolidates and we end up with a group of trillion-dollar firms?
I don't think there will only be 4 or 5 firms anytime soon. There is a real place for smaller managers. There are some strategies that are niche and that may never grow to be hundreds of billions of dollars in size. And for that reason, the big guys are going to ignore them, but they really have a purpose in the world. There are also managers with specific expertise and who have developed an edge in what they do, whether that edge is in origination or in value creation, and that will persist. So I do think that there is a real role for middle market managers. There's also a role for alpha generation. So the bigger managers become, the fewer of them there are in a large scale, the more likely it is that their returns revert to the mean. And I think there is an opportunity for younger managers to beat the average.
Avi, thank you for joining us and sharing your wonderful insights.
Great to be here with you, Joe.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.